Hey guys, Joseph Henson here with Henson CPA Group. I hope you have had a great day and a great week and you are ready for the weekend coming up. Last week, I had a lot of questions that I tried to answer for everyone that we get frequently from veterinarians. And this week, we're actually going to go through the 5 warning signs your veterinary clinic needs a financial strategy and not just bookkeeping. Again, I'm Joseph Henson CPA with Henson CPA Group. Thank you guys for joining me. Thanks for reaching out. When you do have questions, if there is anything else you need, please don't hesitate to ask. There is a call link below that you can click and schedule a free consultation with me or someone on my team. But until then, let's go ahead and get right into it. Most clinics don't have a strategy. They have bookkeeping, they have someone that does tax preparation, and then they have financial reports that are typically going to be underutilized. They don't truly have a financial strategy. And this often shows up as cash flow pressure, tax bill surprises, and uncertainty about your growth decisions. Do I build these exam rooms? Do I hire this doctor? Do I open another day? Do I take this vacation for a relief vet? These are things that we hear often. Here's the first warning sign that you don't have a financial plan. You are making financial decisions without clear numbers. What does this mean? You hire based on the gut feeling. I really feel like we can afford this and that we can use this person, whether that's a vet tech, whether that's a kennel tech, whether that is a veterinarian, but you're hiring just on, well, yeah, I think we can do this or we have to do this, but you don't truly know what they're going to bring to the table. Buying equipment without cash projections. Equipment's not cheap. I've seen them run as far as $150,000 to $200,000, even more if you're doing a complete build out for a new doctor. And if you are just buying these and you're not saying, doesn't make sense to lease the equipment, doesn't make sense to buy it in cash, doesn't make sense to just get a loan, and you just look at this and say, we need it, we have to do it, we'll figure it out, that can be an issue. What if this is what puts you in the negative because you're already running that thin line? And then expanding services without a margin analysis. What do I mean by this? You're adding a service into your clinic that you don't understand if you're actually going to make money off of it. When you expand, it needs to be intentional and it has to be able to make money. When the numbers aren't guiding decisions, your stress will increase. We see this time and time again. Warning sign number 2, revenue is growing, but cash still feels tight. This happens when expenses grow with revenue. You made $1 million last year, top line revenue. You had $950,000 in expenses. This year, you made $1.1 million top line revenue. Your expenses were $1,050,000. So really, you increased revenue by $100,000. You increased expenses by $100,000. You're not seeing any true growth. You're just spending more time doing the same work or even adding work without seeing any bottom line increase. Your inventory is just increasing time and time again. You don't seem to have you have a longer shelf life. It's just sitting there. Some of it becomes obsolete. Some of it walks off and you don't know what. But you just say, hey, they're having a sale. They're offering me a discount here. Time to go ahead and buy it. And your inventory is just sitting there and it's just a cash sink until you can liquidate that and make money. Payroll expands faster than margins. Last year, you're running at 45% payroll revenue percentage. This year, you're running at 55%. You aren't just spending more on payroll. You're outpacing the margins. Every dollar you make, 55 cents goes to payroll this year compared to 45 cents the previous year. Something that has to be looked at. Revenue growth alone doesn't always improve financial stability. Warning sign number 3, taxes are always a surprise. Many clinics experience an unexpected tax bill, scrambling for how to pay that, find cash in March or April to pay that bill, and there is very little proactive planning. They talk about, well, we try to put money back when we can. We're doing the profit first method, sort of, kinda. You're not paying yourself first. You're not putting some back for taxes after that. But there's nothing really happening to mitigate taxes, for one, or for 2, actually pay those taxes. You want to cut. So you're like, hey, let's cut this extra subscription over here to Spotify. Let's remove this. Let's cut these hours. Let's cut my own personal pay. as the veterinarian owner, but you want to cut, but you're okay paying 70, 80, $100,000 to the IRS because you're not being proactive about the planning. Your tax strategy needs to be happening throughout the year. This is not just a filing time. There are steps you can take today to help tomorrow. Warning sign number 4. You don't know your key financial benchmarks. Many owners don't know the payroll percentage of revenue. Like I mentioned earlier, was it 45%? Is it 55%? Is it 70%? You don't know your break-even point. How many people do you have to see to meet your fixed costs? These are your fixed costs, not variable. What is the difference? Fixed is, it doesn't matter how many people you see, this is what you're going to pay. Variable is, hey, depending on how many you see, the cost will fluctuate. You'll use more inventory if you see more people, less if you see less. Your profit margin targets. What is your profit margin target? Well, I just want positive. Yeah, everyone does. But what should it be? 10, 15, 20% profit margin? That's a great question. You don't know. You haven't discussed it with your financial planner, with your CFO, your outsourced CFO, and that leads to issues. And then your cash reserve needs. How much money do you have in the bank if you are sick for a month? Can you pay your staff? Can you pay a relief vet? What does that look like? If not, we need to figure out what is a good reserve number. Everyone always hears in personal finance, keep money to the side just in case. In business, it's, well, we'll figure it out. And without benchmarks, it's hard to know whether the business is performing well. Again, you're relying on your gut, you're relying on cash in the bank, but it's not saying, are you doing well as a business? Warning sign number 5, financial reports don't lead to action. Many clinics receive monthly reports, but never ask, what decisions should this lead to? What trends should we watch? And what adjustments should we make? So what decisions should this lead to? Is it time to grow? Are you at your max capacity? Are you working 60-hour weeks because you are just so full that you need to either hire someone or raise your prices 5 to 10% to start making the same amount, knowing some people are going to leave? What trends are you watching? Are your costs just creeping up and you're not keeping up with that based on inflation, based on needs? Are you watching this? And what adjustments should we make? Are you spending too much time on trimming nails, gland sweeps, your kennel, when those don't make money and you're losing money in those areas monthly, where really you should be spending a lot more time on just the emergency calls and have someone else handle all the other stuff. Have your registered vet tech handling the stuff that they can handle. Reports alone do not create strategy. There are 2 types of financial systems. You have your compliance accounting and you have your strategic financial management. With compliance accounting, this is going to be your typical bookkeeping, your tax filing, your basic reporting. I'm staying compliant just to keep the IRS off my back. With strategic financial management, though, you're forecasting, you are planning, you have a margin analysis. Are we seeing a 1% margin growth a year just for now? At some point, you do cap out. And then your tax strategy. Are we taking advantage of everything we can to reduce our tax bill, increase our take home, and plan for the future? If you are only planning for today, you're not worried about 5 years, 10 years, 20 years when you retire, because you're just planning on, I'm going to sell my clinic. That can't be the only strategy you use. We have to look at a lot of this. Both of them matter, but they serve a different purpose. What strategy actually looks like? A financial strategy will often include several key factors. One is going to be a regular financial review. We've said it before, I'll say it again. If you only review your financials at year end, you've already waited until too late to make decisions. You need to be doing monthly, preferably, but at a minimum, quarterly. Then forecasting upcoming expenses and taxes. None of your taxes should be a surprise. Your expenses, you should be planning for them. You should have a rolling budget that says, I know I need a new x-ray machine and it's going to cost me X. It's going to cost me $25,000, $50,000. That is not a surprise. My x-ray machine is on its last leg. It's time for us to get in there and make sure we know what's going on with it. You need to be monitoring key metrics. Your gross profit margin, your payroll expense as a percentage of revenue, These are two of the most important ones, because if your payroll is 60, 70%, it doesn't matter how much you do, you're never going to be able to overcome that. Then make proactive adjustments. You might have just made a 3% increase to your products across the board in your services, and you're realizing, hey, this year hit different. We're actually needing to make an even larger adjustment. You need to do that early. You can't wait till year end and wonder, why is my money still going down? This will help clinics move from reacting to numbers to using numbers intentionally. The real goal. The goal isn't just accurate bookkeeping. The goal is financial clarity and understanding, being able to make a confident decision as the owner. Then there are fewer surprises, and you want sustainable growth. You don't want to grow at a pace that outperforms your bank. I don't care how many people you see if you're working 60 hours a week. 60 hours is unsustainable. That's not a work-life balance. You probably preach work-life balance to your employees while you aren't getting that. We need a sustainable growth, a predictable growth that can be held onto for long term. That's where many clinics will start to feel the difference. If any of those warning signs sound familiar, it may be helpful to take a closer look at your numbers. We do offer a free strategy call where we review your clinic's financial situation and help identify where pressure may be coming from. No pressure, just clarity on our side. There is a link below that you can use to book a free strategy call with us. You can also reach us at 479-308-8360 or email me directly at joseph@hensoncpagroup.com. I appreciate you guys being here as always. If you have any questions, feel free to reach out.